In addition to taxes and insolvency costs, capital structure choices are also influenced by agency costs. An agency cost arises whenever the interest of the principal may deviate from those of the agent. And we have agency cost of equity when managers do not act in the interest of shareholders, the equity investors. The introduction of debt helps reduce these costs because managers have less equity to use on perquisites and other unnecessary purchases, like a corporate jet, for example. However, debt has its own agency costs as well. Shareholders' interests are different from lenders' interests because they want to use the borrowed money to maximize their wealth, while lenders are interested in getting their money back safely. Actions like shareholders investing in riskier projects or paying themselves large dividends are examples of agency cost of debt. Other things being equal, the greater the agency cost of debt, the less debt will the firm use. Debt holders protect themselves with positive and negative covenants in lending contracts, as we mentioned before. These are some examples of agency cost of debt. The underinvestment problem is that shareholders will not invest in profitable NPV projects because those benefits will go in a large part to the bondholders. The asset substitution problem is the opposite. Shareholders will take on risky projects to increase their return, thus increasing the risk of cash flows and the ability to pay debt obligations. Or when shareholders prefer projects that pay off over the short term as opposed to those that pay off over the long horizon. Or they are reluctant to liquidate the firm when the value of the assets, when liquidated, exceeds the operating value of the assets. Incorporating all these agency costs and insolvency costs, we have the trade-off model revisited, which says the values of the firms is maximized at the optimal level of debt. This optimal level of debt is somewhere in the middle, where the agency costs and insolvency costs are offset by the benefit of tax shield. Evidence has shown that, number one, the most profitable companies in an industry tend to have the lowest debt ratios. Number two, leverage increasing events like share repurchases almost always increase the share prices because market takes it as a signal that the management believe the shares are undervalued. And number three, companies issue more debt than equity. This is because firms follow a financing hierarchy, regardless of the implications of the trade-off model of capital structure, with retained earnings being the most preferred choice of financing, followed by debt, and that the new equity is the least preferred choice. We refer to this as the pecking order theory. The underlying assumptions of this theory are that the managers tend to maintain a stable dividend policy. We will talk more about that in our last module, Module 10. Companies prefer internal financing to external financing. Because of the high cost of external finance, they chose to use their internal funds first. If they must raise external funds, a company will issue the safest external security first. If a company requires more external equity financing, it will work down the pecking order of securities. Debt first, then equity. One of the main reasons for the pecking order theory of capital structure is information asymmetry, where managers are reluctant to convey negative information to shareholders, employees, creditors, suppliers, etc. The pecking order theory also infers that firms will tend to build up cash in good times. We call this financial slack. For the same reasons, a firm with excess cash will pay off debt before repurchasing shares. These are the factors that CFOs consider as important when deciding to choose debt over equity financing. Financial flexibility. This might include certain debt covenants like the ability to settle the debt early or having the option to change the coupon rate. And credit rating are among the top. Of course, you want to issue debt if your credit rating is high, so you don't have to pay a high interest rate. These are followed by the volatility of cash flows and earnings, insufficient internal funds, and the cost of debt and the tax shield as factors to consider when choosing debt. This concludes Module 9.